In this video, we will talk about the Reserve Bank of India, RBI, how and when it was established, where its headquarters is located, and who was its first governor. We will also explain the important roles of RBI in India's economy. The Reserve Bank of India, RBI, is India's main bank that manages the country's money. It helps control prices, loan interest rates, and the amount of money in the economy to keep everything stable. The Reserve Bank of India, RBI, started working on April 1, 1935, under a law called the Reserve Bank of India Act, 1934. It was created to keep India's economy stable and support its growth. The headquarters of RBI is in Mumbai, Maharashtra, India. The Reserve Bank of India was set up on the basis of the recommendations of the Hilton-Young Commission. The first governor of RBI was Sir Osborne Smith, who served from April 1, 1935, to June 30, 1937. He was a banker with extensive experience in managing financial institutions. You can learn more about Sir Osborne Smith on the official RBI website, where you'll also find a list of all past governors, their time in office, and their key contributions. Reserve Bank of India, RBI, was initially a privately owned institution when it commenced operations on April 1, 1935, under the Reserve Bank of India Act, 1934. After India's independence, the Reserve Bank of India was nationalized with effect from the 1st of January 1949 on the basis of the Reserve Bank of India, Transfer to Public Ownership, Act, 1948. Now we are going to look at the role of RBI in the Indian economy. 1. Monetary policy implementation. The Reserve Bank of India, RBI, helps keep the economy balanced by adjusting interest rates, which controls the flow of money in the market. When RBI changes interest rates based on economic conditions, it decides how costly or affordable loans will be for people and businesses. This helps in keeping prices stable, managing spending, and supporting the country's growth. I will explain in detail how this process, called monetary policy implementation, works in a separate detailed video. 2. Issuance of currency. The Reserve Bank of India, RBI, is responsible for printing and managing India's currency. The decision on how much money to print is based on the economy's needs, following strict regulations set by the Indian government and RBI itself. Using a careful and data-driven approach, RBI ensures there is enough cash to support economic growth, while preventing excessive money supply that could lead to inflation or currency devaluation. 3. Foreign exchange management. The Reserve Bank of India, RBI, manages India's foreign money reserves and controls the exchange rate of the Indian rupee against other currencies like the US dollar, euro and other foreign currencies. It ensures that India has enough foreign currency for trade and imports, while keeping the exchange rate stable to avoid big price changes. This helps in maintaining a strong and balanced economy. 4. Banking regulation. The Reserve Bank of India, RBI, oversees and controls banks to make sure they follow rules and operate safely. It ensures that banks handle money responsibly, protect customer deposits, and follow fair practices. RBI also sets guidelines to prevent fraud, bank failures, and financial crises, helping keep the banking system stable and secure. Now that we've talked briefly about the Reserve Bank of India, RBI, its setup, and its role in the Indian economy, it's time to explore some other important banking concepts in detail. In the upcoming videos, we'll explain repo rate, reverse repo rate, cash reserve ratio, CRR, and other key banking topics in a simple and easy way for better understanding. Don't forget to check out the other videos in this playlist for more easy to understand details.